Hey guys, Aaron here with Carnivore Trade. So doing a special video here today. It is August 10th, 2024. If you've not done so already, please give the video a thumbs up. If you like the content, comment, and subscribe. And come find me on carnivoretrades.com for swing trading alerts, analysis, and live day trading. But anyways, let's get into it here today. So I want to talk about how to navigate a bear or high fear, high volatility environment like a pro trader who's done it many times before. And we took a bunch of trades here in the trading room this week, but I really want to talk about kind of the middle of the week. But first, I will get into kind of the psychology of where I was at going into the week, because it's important to understand that first. So right now, we did have so first things first, actually. If you're in this environment here where VIX is flying off the handle, anything above 25, really, generally that's historically a little elevated. Anything above 30, you could make a case that you should just start buying long-term positions without asking questions. I, made that case on Monday as well. But it's also a period where if you're short-term trading, you need to be sized down by at least 75%. That doesn't mean you can't add more size into those positions, via DCA models, but you should be starting small. And I did that on Friday. So the reason I did that is because, essentially I picked up a starter ES at 54.03. And obviously we went down further, which we'll talk about more. But, we had some fibs in here. If I can get my fib tool. April low, 50% retrace, 100 MA. If you look at the Qs, right, 618. Right into that area. So we had some reasons to put a feeler position out there. Additionally, why was I even trying to play long? The market's going down. Why would you play long? Well, you can't, this is what we would call shorting into the hole. So like you can't play bear in this situation. You certainly can't play it on Monday, right? NASDAQ here, the triple Qs were down 7% in about 11 trading days, I think it was. Actually more than that now with Monday's drop, but basically this move from here to here is the same from here to here in April, and like half the time. You can't play bear there. You have to wait for a bear flag or a rebound, a retrace, something like that, in order to play bear outside of intraday level. I'm not saying you can't scalp. We took a bunch of short scalps throughout the week, but looking for like a macro 1 to 3 day hold, you definitely can't do that. So that's kind of the premise there. Another reason is pretty simple. I mean, like the VIX at 66, it's happened 1, 2, 3, 4 times ever. So 1987, 2008, 2020, and now. Were either of those times good times to buy stocks? Well, there you can't even see it. There's 1987. Right there. There's 2008. And there's 2020. So answer is yes to those questions. Again, that doesn't mean we can't go lower. It doesn't mean there's not danger, but you see that you start to really get an idea of the position that you're in. Additionally, sentiment, and that's going to be a huge part of this video, kind of when I get into the later part, but I'm just kind of explaining the psychology here of what I was looking to do, which is catch a huge short squeeze. And Investor Intelligence Survey, 2-week change, the largest since 1987. There's the same good time to buy stocks, right? So more people turned bearish from bullish at the fastest rate since 1987. They're still at a neutral reading, but that's very quick. We went from greed to fear very fast. Speaking of fear, greed, as of Friday, it's a 24. It was at an 18 or a 19 intraday on Monday, I believe. So very overdone readings here. Also, liquidity levels versus via the ES book size. Silicon Valley blow up a couple of times in 2022 and then COVID. So very thin book. Well, what does this line mean, right? It means that it's at an absolute extreme. So these times are not likely to last. And those who are late to the party buying hedges When the inevitable bounce does happen, right? You hit the 200 moving average, for instance, on the ES. You gap through it on the Qs, and you get a technical retrace. The most likely move is a massive short squeeze. So I want to be on the long side, right? If I'm not short up here and just trailing on the way down, the only way to play it is to look for quality long setups, DCA into big levels, and then look for that big squeeze. That doesn't mean you can't short resistances. Like I said, we shorted multiples this week. We got 52.50 very nicely. We got the we caught the SPY here at 520. What was it? 522.50 or 529.50, and then we got NQ in the morning the next day. A couple just quick short trades, but you don't want to be macro short here. You're not looking for the next big move. So I was positioning long, and I did add to ES on Monday after the coast was a little bit clear here. Now again, left myself plenty of room, but not really the point here. We did make money on that. We lost a little bit of money on a short hedge. We made some money on some other shorts. But the big move here was going into Tuesday. That's really what I want to talk about. So let's take a look here. So if we go over and we take a look back. So the 6th was Tuesday afternoon. And you can see my comments here in our Discord. And I said, if you're bullish, I don't think you want us to pump tomorrow anyway. This is at 6:54 p.m. Well before the BOJ flipped and went and capitulated, which was, the funny moment of the week. But we had that late day sell, right? Look at the characteristics. This is important to watch this. We had a gap up. I did a whole video on this. Markets don't bottom on a gap up. At least very rarely they do, but handful of exceptions. But we had a gap and go, late day fade. When you get that in a bear market, it's deflating. It takes the wind out of the bull sails. You had a nice bull pattern there in the afternoon. It tried to break out. It failed. We sold our ES long that we DCA'd in. We actually went short here. Sold a little too soon, but it worked out. Again, 53.15, big resistance. I talked about that all day Monday and Tuesday. Next day, gap up, early rally. Where did we go? 53.25. Let me put that highlight on there again because we're going to look at it. 53.25. I would not shut up about this level all week long, right? And I told you if we get above that, we're going to rally. And that happened on Friday. But we gap up after the BOJ news. I had no idea. When I said this right here. I had no idea that Bank of Japan was going to do that. But we sold off in the overnight. We gapped all the way up, rallied in the morning. Then we faded around the lunch hour all the way into the close. Why would I say that? You think a recovery, you think V-shape, right? So why would I want us to be weak into the close or even flat to negative on Wednesday? The reason is sentiment. I could see things kind of coming into place here. Wednesday, if you're not familiar, is the last day that AAII runs its survey. So they runs it from Thursday to Wednesday. And I was banking on people being really bearish. You can see the previous week, the week of the 31st of July, the bulls actually upticked and the bears downticked pretty substantially. Let's review that really quick before we get into the next part. What week was that? Oh, the 31st. Or week ending, rather. So it was right here to, that's the 30th. So, yeah, there. Bulls got bullish after that FOMC, right? Wednesday, the 31st. We had that big move. Even I thought we were going to inch a little bit higher. I didn't see that much of a bear rejection. I said I was very impressed with the bears there. But you can see the bulls uptick. That's probably why we got rejected. We came down, and we had a very good rally for 2 days. We also had the BOJ news. But I said, for a bottom here, the best thing that could happen would be a bear, bear like kneecap, right? Like the bulls need to just get like demoralized, like slapped in the face, but without actually breaking any technical levels. Or if we do break a technical level, you want it to just like spike, like just capitulate down, like a spike of the low or something like crazy like that. But because then you're just going to get to serious max fear. But where did we go here on Wednesday? Right to the 618, right? It's standard retrace. Everybody got really bearish. I'm pretty sure I'm the only guy. I know I've said this a couple times. I'm pretty sure I'm the only guy that I saw who got more bullish, not just bullish, more bullish with Wednesday's close. I rooted for it. I was praying for it. Why? Because Wednesday, look at what the bears did. They surged and the bulls dropped. And what happened? Here's the next key part of our little story here. And this is where we made the real money this week. We did pick up a starter ES here, 5245 SPX, so it's 5270. Yeah, 5270 ES. We got a starter. And Friday morning, we picked up NQ. We got a nice, we essentially doubled up there. But the reason I picked that starter up is because I was really banking on bears upticking. They did. But here's the second part. What happened the last 2 days? We gapped up. We had a gap and go, rally, short squeeze, bull flag, tried to bring out failure. Gap and go on good news, bull flag beneath resistance. I covered my original ES that we had DCA'd into right up here and actually went short a little bit. Excuse me, that was the day before. Correction. Right here we were in cash and I was looking for a reason to go long. We did short the NQ for a scalp up here. I was looking for a reason to go long. So if we consolidate, we're doing like basing type action up here. We're seeing, and I just said this multiple times in Discord, but even said on Twitter, still a ton of resistance here. Bulls need more of a base despite the BOJ news. I even said like, we probably need a dip. And we got that. But why did we hold the gains today? Why did I say the night before at 6:13 p.m., I'll be interested to see if they run the same playbook with a rug pull tomorrow. If we gap up and are sideways into the afternoon, it is likely that pikers, meaning retail or just crappy institutional traders, will start shorting in anticipation of another late day fade. That's 2 days in a row now. Usually they do this 3 days in a row. The third one ends in a reversal. Said this at 12:30 on Thursday. The problem now is that everybody is conditioned to expect a late day dip. I've said that to one of our members. What did we do Thursday? Gap up, rally, bull flag into the lunch hour. See that little dip there that got bought? There's a reason for that. You see this little dip here that got bought? There's a reason for that. They're not going to give you that same setup 3 days in a row. And in bear markets, positioning is everything. In bull markets, the market can just grind higher on dopamine, right? Liquidity and dopamine. But bear markets, you get to extreme positioning very quickly, and certain trends catch on very quickly. And with that close yesterday, let me tell you, when you gap up on good news and you can't hold the gains, that's like the death sentence. That is one of the worst things that can happen, except when you're already at historic low liquidity levels, historic VIX levels, historic all this other stuff, right? So I knew people were going to be bearish. I knew people were going to look for that late day fade. They all jumped on short right here and right in here, thinking that we were going to have a big collapse. And what happened Friday? We went sideways and all we did was just base out this range, and then we pushed up and went to 53.50, actually exceeding that pretty nicely. And in the trading room, we got, what did we get here? A pretty good gain. So sold half of ES at 22. That was 52 points. Then we sold NQ for 50 points at 18,515. Another 161 at 66. And then 103 points on ES at 52.73. We still have runners here into the weekend. That is how I navigated this week. So a couple of things, I guess just veteran things, perhaps. I know that it's something that takes time and it's very hard to buy in this situation when everything's telling you not to. But you just got to condition yourself to do that. And also know that in the worst case scenario, even if we do, like, let's just say, I'm not saying this is not a bull versus bear video, by the way. We could go up here and then crash for all we know. But nothing goes down in a straight line, even in COVID, right? Is that long ago already? You got to go back 5 years. Even in COVID, you had 28, 60 to 31, so we had a humongous bounce here, right? That's 10%, 10.5% in 4 days, right? So you don't need to be right about the macro move. You just need to make money off it. But that's how I navigated it. Again, use sentiment. I did a whole video on this. Maybe I'll put it in the recommended videos there. But it's basically on trader tools and stuff you can use. AI is very good. But yeah, positioning, sentiment, and just keeping a level head. It's never as good as it is, and it's never as bad as it seems. Zoom out, look at the macro things, not like literal macro, but just like the macro picture. Size down, that's probably number one. I probably should have said that 10 more times in this video. That's the biggest thing, is sizing down, because that enables you to handle those big swings. We were out of the money, probably like 150 points at one point on some of our futures trades, but I'm not taking 50 contracts. I'm taking a small handful, right? You have a wide range. If you're using SPXL or SPY, you can do that. Just size it down 70, 80%. And go from there. So anyways, guys, hope that helps you guys. Let me know, questions, comments, concerns. Did you buy? Did you sell? Did you learn anything from this week? Thoughts on next week? Outside of that, you guys take care. Have a great rest of your weekend, and I'll see you guys all on Monday.